Stocks and bonds down for the day. Gold up quite considerably, 1.52%. Let's jump into the weekly charts as we always do. We start with the S&P 500. We're building a strong down week as we go into Friday. Down again 1.60% for the day. Big, long, strong down candle, the longest we've seen going back many, many months. Price percent oscillator, again, just hawking down. We see the derivative oscillator gaining downward momentum after many, many weeks of losing downward momentum. And we go from the weekly to the two-day. We've had the latest two-day candle has been drawn at this point. And of course, it's another strong down candle, 3 in a row, getting stronger. Derivative oscillator gaining downward momentum, price percent oscillator spiking over, going down. And we look at the 4-hour chart. What do we see? Again, down, 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 down after many, many, many days. No pullback for us to find an appropriate jumping in point. And again, encourage you to experiment around. The reason that we wait for pullbacks is, of course, to find a good jumping in point, one that we can rely on. Jumping in at just any time can be extremely dangerous. Some of you are asking, after you see the derivative oscillator go green and pull back in the same direction as the down moves, can you jump in? The answer is sometimes. Sometimes you can do most anything. But the problem is, of course, you want to be able to reliably find jumping in points. And we have discovered that when you have pullbacks in the opposite direction of the intermediate, that's the two-day, and the long term, that's the weekly trend lines, when you have a pullback on the 4-hour and then it reverts into the same direction as the two longer trend lines, the two-day and the weekly, that's your safest jumping in point. We haven't had that on the last strong down move. So we're continuing just to watch it track down and to wait and see when a jumping in point presents itself. Now, some of you are asking, what about just staying in the weekly as long as it continues to move down? You can, of course, do that. You do take the risk of a pop back. We saw things move back up quite strongly on that week ending the 9th of November. And that, of course, would have given you some pause for concern. Don't forget how well we did. Was it $10 or $15 worth of down movement that we had during that initial crossover going down where we had that weekly vertical crossover? It was beautiful. So you don't have to make all the money in the market. What we're trying to teach you to do is to do practice trades and take the biggest, safest chunk and let the rest of it go. First rule in trading and investing, don't lose money. Second rule, make money. And you make money on the clean, clear moves. There's plenty of moves, but if you get greedy, chances are you're going to get stung. That's where we are in the S&P 500. Let's go to the Qs, down 1.33% for the day. Again, another strong down candle forming in the Qs. One more day on the weekly candle. Derivative oscillator still losing downward momentum. That price percent oscillator spiking down for the week. Go to the two-day chart. Of course, we had that two-day crossover going down back on the two-day candle ending the 18th. And this is the second one after that move. And again, derivative oscillator gaining lots of downward momentum. Price percent oscillator heading down on the two-day chart. We look at that 4-hour chart. Down strong in the morning and the afternoon. No pullback since that two-day crossover. So we haven't had a jumping in point yet on the Nasdaq 100 as represented by QQQ. Still waiting to see. And again, don't forget how well we did with that initial strong down movement when things first crossed over on the weekly vertical crossover. So again, that's our main method of jumping into these moves and doing very, very well. And of course, it worked beautifully for us. As the moves get older and longer, it gets more complicated and harder to stay in and to figure out what's happening as we continue to move along. So again, we took a nice solid chunk and did very well in our practice trades. Now, and we'll continue to look for potential jumping in points for further movement. We're going to TLT now. That's 20-year bonds. Remember, we had that weekly vertical crossover back a few weeks ago, and we're going into our third week of strong up movement. Derivative oscillator moving up strongly. Price percent oscillator heading up on bonds. We go to the two-day chart. And of course, it's continuing to move up quite strongly. Derivative oscillators about flat. Price percent oscillator moving up. Big green open box candle on that latest, and one of the not the biggest we've seen. The biggest we saw was back on the 2-day candle ending the 6th of December. But again, strong up movement on this latest candle. We go from the 2-day to the 4-hour. Strong up movement in the morning. A little bit of a paring back in the afternoon. Now remember, we had that crossover in the morning on the 19th, had that potential jumping in point in the afternoon on Wednesday. Strong up movement in the morning, bit of a pullback, so keep your eye on things. We have a red spinning top, open box spinning top, so not as weak as a solid red candle, but again, a bit of a pullback in the afternoon, down for the day 0.40%, just barely. Derivative oscillators lost some momentum. Price percent oscillator has kinked over in the afternoon. But when you look at your 2-day and your weekly, of course, those are still quite strong. So we shall now go and move back to the weekly chart and go to our last chart. The only one up for the day, 1.53%. Gold is moving up. Now remember, gold crossed over going up all the way back on the 5th of October. Went up for 3 weeks, down for 3 weeks, and been going primarily up for about the last 5 weeks. I mean, we had that 1 week of indecision ending the 30th of November, but the last 3 have been pretty strong up movements. Derivative oscillator moving up, price percent oscillator moving up on the weekly chart. We go to the 2-day, we can see it spiking up, and of course this latest 2-day candle quite strong. Derivative oscillator gaining upward momentum, price percent oscillator heading up. We look at that 4-hour chart. What have we been waiting for? Of course, what happened in the morning? That crossover going up after that pull back, and then we saw further up movement in the afternoon. Your jumping in point, of course, was after the crossover in the morning. In the afternoon on gold, hopefully you pulled the trigger on a practice trade there, and we'll continue to watch the 4-hour chart and see how well gold does for us. So again, no jumping in points on the S&P 500 and the Nasdaq 100, but of course, jumping in point in gold today and a jumping in point yesterday in bonds. So we'll continue to watch those, track those, practice those, and see how they go. Now remember, if you've jumped into those trades, do use your trade worksheet. If you don't know where that is or what that is, you can find it for free in the show notes. If you're not a subscriber to chartingwealth.com, please be one. You'll get an email every day, and the show notes are there. Links to the PDFs are there. You can also go to chartingwealth.com and look under the daily reviews, and you'll see the show notes there. You'll also see the show notes in your notes if you're listening to the podcast or if you're tuned into the YouTube channel. And please subscribe there. But most of all, subscribe to our daily market reviews. It includes our comprehensive review and forecast, and we email it to you at the close of business every day when we get it done. That's all we have today, folks. Hope you purchased our book. Appreciate everybody purchasing those for the holidays. Links to purchase those are also in the show notes. God bless, my friends. All the best from the whole team here at Charting Wealth World Headquarters.